Hello. So I've made a few videos on options trades going into earnings. So I'm going to just make one now that kind of sums up all of the gains and losses and how the trades have panned out. So first off, I'm going to look at a call that was Dave Santarelli's. So if you're part of his Facebook group, you know him well. He posts lots of different option strategies. And on one of his calls, I decided to make a video because I liked Amazon also going into earnings. And he called the $500 strike. So we both paid, I think, $12.90 premium for the $500 strike the week of earnings, which was a cost of just over $2,500. Now, as I'm sure you know, Amazon reported very well and skyrocketed at the open the next day. So those options, which unfortunately both of us closed most of them out a bit early, but those options at the open the next day that we paid $12.90 for were now worth over $80 for a nice little profit of just over 13,000 or 520%. So obviously you can't expect these types of gains on every options trade, but that was a fantastic trade and we have to credit Dave Santarelli for that call. Now next I'm going to look at a couple of protective put strategies I used. So we know that the tech stocks, Amazon, Google, Netflix, had all been skyrocketing after earnings. So one strategy I used to play this was buying the stock. So I bought both Twitter and Facebook just right before earnings, the day of or the day before, and then bought puts on the stock as well. So that way I had limited downside risk, only a couple hundred or a few $100s in each name, but a lot of upside should the stock skyrocket, like, as we said, Amazon, Google, Netflix. Well, what happened with both stocks is they went up after hours. So I was able to sell the stocks. So I sold Twitter at about 40.50 and Facebook at 97. So I was able to sell the stocks and then hold on to the puts for the next day. Now what happened with both stocks is they skyrocketed after earnings and then fell back down, so that the next day the puts were actually very valuable and I was able to sell those to make a nice little profit on each trade. Now the Twitter one, I was able to make a lot more, 1600, because the stock swung about $8 from after hours to the next day, which amounted to about 20% of my investment. And Facebook, the percentage was small, under 2%, a little over $300. But remember, these holdings were only for 1 or 2 days. So the initial cost was just margin. I wasn't putting my actual money in these trades. I was just trading with margin because I knew I had very, very limited downside risk. So I actually made quite a bit more than the risk I had in these trades. Now, the only trade that I did through earnings that you could say was negative would have been my Qualcomm caller video. Now, in that trade, I bought Qualcomm stock because it was nearing 52-week lows. I thought it could get a decent bounce if it reported well. Unfortunately, the stock did go down, but since I sold a covered call and bought a put, which hence is the caller, I had very limited downside risk. So I was actually net long the stock, slightly higher than the market price at the time, and I had very limited downside. So the stock didn't really go down that much. So I ended up just being long the stock, and my break even was 64.69, which is pretty much what the stock is trading at right now. So my max loss would have been a little over $200. The stock did fall, but then it's bounced back since. So I'm basically just long the stock right now at around a break even. And I am holding that one because I do see some upside in that. My most recent trade was a diagonal call in Lending Club. So there I purchased an October $10 strike call and then sold an August $14 strike call. So as long as the stock trades above $14 come August expiry, I'd make a nice 22% profit. I currently am still holding this, but the stock did report fairly well after hours, and it is trading above the $14 strike. So it looks like this one will be a profitable trade as well. And what I will probably do with this trade is buy back the August $14 strike and then sell the September $14 strike and then continue that again, roll it over again into October for a little more premium throughout this trade. I really don't see a lot of downside in Lending Club. They're near the 52-week lows. Lending Tree was up 40% on their earnings. So I think you'll see a slight rise in Lending Club over the next few months. Probably my favorite trade of this earnings season was my first call, which was a risk reversal on Sandisk. So I sold the 53.50 puts and bought the $54 calls, which at the time the stock was trading around that range, high 53s. So basically I was saying I'll buy the stock if it goes down, but I get all the upside if it goes up. And it did go up into earnings. It went to over $60. So with a break even of 53.41 and actually no cost to myself whatsoever, I actually made $44.02 putting on this position. I was able to get a profit of $3,234.03. And you can't really measure the percentage in this because it didn't cost me anything, but that would be 7,346.73% just based on the $44 that I made. But again, that's money I'm making, not spending, so it's actually impossible to calculate a percentage return when you're being paid to put on this options position. But that just shows how much of a gain there was on that play. Then the Baidu long Strangle. So looking at Baidu and the China volatility, I expected big moves in one direction or another, but not really sure which. So I bought a couple contracts of the $200 call strike and a couple contracts of the 195 put strike when the stock was again trading in that range around 197, 198. So my total cost was about $1,500 for each position for a total of just over $3,000. And the stock had to move almost 10% in either direction to be profitable. Well, again, as you probably know, the stock moved much more than that. Baidu got into the low 170s and below into the 160s. So I was able to sell that put for around $32 when I had only paid $7.70 for it. So that made me a nice profit of just over $5,000 or 160.92%. Now my last options trade of this earnings season was an Alibaba long straddle. Now I put this on a few weeks ago, but just closed it out today after they reported. So what I did was I bought 3 calls at the $80 strike, and I bought 3 puts at the $80 strike for a total cost of $2,264.48, expecting some volatility in Alibaba with earnings and the whole China situation. So my break even initially was 87.55 to the upside and 72.45 to the downside. But what I did was I also sold some calls and sold some puts nearer term before earnings. So I was able to collect a little bit of extra premium before the earnings not expecting Alibaba to move too significantly prior to earnings, and then expecting that big move once they reported, which is what happened. Today, Alibaba reported, stock fell to around 72. I was able to sell my puts for a small gain with the extra premiums I had of $206.78 for a nice percentage return of 9.13% in 3 weeks. Now, this strategy was a bit of a combination of a long straddle, and I also used a double diagonal, which I'll make a video for at another time. But even had you just done the straddle, you still would have been in a positive position. Now, the longest term options play I did was a diagonal call on American Express. So at the time, American Express was trading around $74, and I saw very limited downside with some decent upside, but didn't want to buy the shares at $81 each. So instead, I bought calls. So I bought the 42.50 strike for $33.60. So I was able to control 400 shares for $13,450. And then against that, I sold the 77.50 strike for the most recent month. Now, I did this position in July, so that was for the July expiry. Now, what happened was the stock was trading slightly above this 77.50 upon the July expiry. So I bought back this call and then sold another one for the August expiry. Now, since we've had some activist investors coming into American Express, driving the stock price up, so now it's at $81 well through the strike. So now, at the strike price, if I let it expire in August, I'll have made a profit of about $1,300 or almost 10% in 2 months. Or another option is I could buy the strike back again and then sell out to September. Because it's already well in the money, unless American Express pulls back maybe $1 or $2, I probably wouldn't do that. I'd probably just close out my position and be happy with a 10% gain, which is very good, obviously, for 2 months. So to summarize all of my options trading videos from this earnings season, I did the Amazon calls with Dave Santarelli, the protective puts on Twitter and Facebook, the caller on Qualcomm, the diagonal calls on Lending Club and American Express, the risk reversal on Sandisk, the long strangle on Baidu, and the long straddle on Alibaba. 8 of the 9 being profitable, Qualcomm only being the only negative one with a slight loss, for total gains of $24,177.74. I hope you enjoyed my earnings season options strategies videos. Please subscribe to my YouTube channel and share. Also, you can follow me on Twitter and add me on Facebook, Day Trade Canada, and visit the website. Happy trading.